In this short video, I'm going to share with you the basic calculations I use when I'm looking at either a flip deal or a buy-to-let deal. Hi, my name is Mark Lloyd. I'm co-founder of Property Master Academy and been a property investor since 2005. Now, if you're new to this channel, please hit the subscribe button. That way you get notified as and when new videos are posted, which I do every single week. So let's take a look first of all at a flip deal. If we assume a purchase price of £200,000, okay, so reasonable size property, and that can apply also in different areas of the country. What costs have we got involved? Well, one of the first costs we've got is stamp duty, £6,000. Now that's assuming you're buying it either in a limited company, or if you're buying your own name, you've already got other properties. But if this is your first property, then you may well get a relief, and that will be a reduced figure. What else have we got? We've also got legals. And I'm going to say £1,000 for legals. Now I know it will vary in different areas of the country. In my area, I pay between £1,200 and £1,500, but I know in some areas you can get less than £1,000. So, just to try and keep the figures simple, we'll say £1,000. Now, it's a flip, so we're going to be refurbishing the property. Let's assume, therefore, that we're going to spend £30,000. So £30,000, decent refurb to add some value to this property. Now, ideally, what you're looking for is for every £1 that you spend, you want to be creating at least another £1 to £3. So £1, £2 or £3 on top. So, for example, what I mean is if you're investing £10, you want to be making at least another £10 on top as a minimum. So doubling your money. Ideally a bit more, because obviously the figures work a lot better. And when we're buying here, we're aiming to buy below market value, BMV, or at a discount. Why? Because that's how we create most of our money. If you actually buy correctly in the first place, that's when you make your money, when you buy, not necessarily when you sell. I know that sounds a little bit confusing, but you make your money when you buy. So we're going to buy at a discount. So we're already building in some equity into the project, and now we're going to add some more by adding a refurb that's going to force some capital appreciation to the project. So that's how we're going to make our flip profit. So these are our initial costs. Now, how are we going to finance this? Well, it's unlikely you're going to be able to finance a flip on a buy-to-let mortgage. In fact, you shouldn't really do it anyway, because buy-to-let mortgages are term products. In other words, that means they're designed to run for a number of years. So what you should be looking at really is bridging or crowdfunding. They both operate very, very similar, and as many of you may recall, we have our own crowdfunding platform that does this service. Now, how does bridging work? Well, there's a number of different variables as far as bridging is concerned, so I'm going to go with the norm here as to how a lot of companies actually work, or sorry, I should say the majority. Majority will lend 70% loan to value. Okay, so loan to purchase price, so in this instance, £200,000. So if they're lending 70%, that means our deposit in this instance is going to be £60,000. Okay. However, there are some other costs you need to take into account as well relating to the bridging. So there's going to be fees involved. There's also going to be interest involved. Now the fees again vary. Some bridging companies charge an upfront fixed fee. Some charge a percentage fee. Some charge a fee at the end as well. And then there's interest in between. So if we assume, let's say there's going to be a 2% fee at the beginning, okay, and also 1% per month. And we're going to do a 6-month project here. So in other words, we've got 6 months of interest at 1%, which is 8,400. And we've got a 2% fee at the very beginning on the 140,000 that we're actually borrowing, so that's 2,800. Okay, these are costs that a lot of people miss out on. And if you're getting it on a mortgage, by the way, you're still going to have a mortgage fee built in there somewhere that's added onto the mortgage. So don't forget that. It's a lot of costs that people tend to forget about, and because they're hidden, you don't actually often see them. Now, a lot of bridging companies will take this amount off of the amount you're borrowing. So if you're borrowing 70%, which I said was, just to confirm, is 140,000, they will deduct these figures from the 140,000, so you receive a net amount. Now, our crowdfunding platform doesn't work like that. You pay the interest monthly, so you actually get the full amount. But it's still a cost that we need to take into account. Okay, so how much have we actually got in this deal? So we've got our stamp duty, our legals, we've got our refurbishment money, obviously we've got our deposit, and we've got these costs here as well. Now, if we total that all up, that comes to £108,400. So that's our cash actually we're having to put into this deal, okay? On top of, obviously, the bridging finance that we've got in this instance of £140,000. So it's quite a lot of money we've got to put in. So what's the end value? Well, let's assume we're getting an end value here of something like £300,000. Now, the important thing to remember when you're working on a flip project is looking at your margins quite closely. Now, there are many, many different ways of working this out. Some investors work on a percentage margin on cost. Some work on a percentage margin on GDV, in other words, gross development value, which is what this figure is here, the GDV. Now, if you're on larger projects and you're looking at development projects, you need to really be working on a minimum 20% margin on GDV. When you're looking at smaller projects, that's not so precise, and I work on at least a margin on cost to make sure I'm making a profit. So, for example, my costs here, 108,400. How much percentage margin do I want to make on top of that? And that will vary from investor to investor, and you need to find out what's comfortable for you. One thing you need to be very careful of is making sure you are making a decent margin, because if the market changes against you, you could well end up costing you money, could end up losing money. So that's our cash in, 108,400. So how much profit are we actually making? We've got our £300,000 target here, and we've obviously got the costs in between. So what costs have we got in between? Well, we've got to take off our stamp duty, we've got to take off our legals. Don't forget the legals on the sale as well. Now I'm going to keep that also at 1,000, because they will vary. Again, I'm around about the 1,000 to 1,500 mark, but in some areas of the country it'll be cheaper. So we've still got legals on the sale. Don't forget also you'll probably have an agent. So now an agent is going to be, let's say, another 2%. So £6,000. And of course there'll be VAT on top of that. Okay, so let's change that figure. To 7,200. Okay, a lot of people forget about the VAT. In the solicitors examples, I've kind of included them there, but just to make the point that you don't forget about the VAT on these costs. So we've got to take the stamp duty, 2 sets of legals, the estate agent's fees. Obviously, we've got our refurbishment cost coming off. Then we've got obviously our bridging costs, which was 11,200. And then we've got the cost of the property, obviously 200,000. So, what's our profit on this deal? So our profit on this deal is £43,600. So what does that relate to our investment? Well, to work out our return, what we need to do now is take this figure and divide it by this figure times by 100 to give us a percentage return. And that return is 40.22%. Not a bad return on your money, is it? Now, where else could you put your money into a project in 6 months and make 40%? That's amazing, isn't it? Amazing return. Obviously, this is just an example, but I have achieved these kind of figures and more. So I know they're definitely achievable. So let's now take a look at the buy-to-let example. So I'm going to use the same figures as I used in the flip example, but just a couple of things to bear in mind, mainly to do with the refurbishment. Generally speaking, on a buy-to-let property, your refurbishment won't be as high, won't cost as much. Why? Because you're aiming for different markets. You're aiming for the rental market with a buy-to-let. With a flip, you're aiming either at the first-time buyer or family market. So often those specs will be a little bit different. The flip project costing you more than the buy-to-let one, but not always the case. But for simplicity, let's keep the figures the same. So we've now done the refurbishment, and we're going to refinance at this point. So we're going to come off the bridge and go onto a buy-to-let mortgage. Now here, we've got the £300,000 value determined by a RICS surveyor this time, whereas in the flip example, we've sold it for £300,000. So we've now got a RICS surveyor saying it's valued at £300,000, and you'll pay for that through the lender. The lender will lend you usually about 75% of that figure. So that means a mortgage of £225,000, which is 75% loan to value. Now you will have a few other costs at this point on the refinance point as well. So you've got a broker fee, a valuation fee, and legals as well, possibly. So the broker fee, first of all, let me just cover that. I'm a firm believer in paying a broker a fee. I don't like the brokers that don't charge a fee. I often find they get inundated with business and don't provide the service I'm looking for. So I'm always happy to pay a broker a fee. And often that's going to be somewhere around about, let's say, the 500 mark. It could be less. You might find your broker's 250, 300, but let's say up to £500. The valuation fee will probably be very similar as well, because it's costs you've got to pay. And you've got the legals as well. Legals, some lenders will cover the legals for you. Others don't. There's a contribution towards them. But again, let's just put in a figure there, and let's say another £500, just because all you're doing is refinancing here. There's not as much work for the solicitor. They're just changing lender over. So we've got a few costs here. There's one other which most investors miss out on, and that is the lender fee. Now the lender fee is actually added on to your mortgage amount. Okay, and it could be a percentage, it could be a fixed sum, but it is added onto your mortgage amount. It's often interest free, so it doesn't add to the amount of interest you're going to pay on the mortgage, but that's one thing you need to check in the terms and conditions, because it's saying that's the normal practice, is it's added on to your mortgage. So we've got all these figures now. What else do we need? Well, of course, we now need our rental income. So our rental income, and let's assume for the purposes of this exercise, we're getting £2,000 per month in rental income. Now that's quite a healthy income by any stretch of the imagination. But what costs have we got to take off? Well, clearly we've got to take off the mortgage, but then there's other things as well. Agent. Now, if you're managing your own properties, that's fine. It's not something I particularly recommend. Personally, I'm very much a hands-off person, so I want other people to manage these things for me. But an agent is going to probably be round about the 10% mark. So that's going to be £200. Of course, we're also going to have insurance. And on a typical buy-to-let property, that's probably going to be about £20 a month. Might be slightly less, might be slightly more. And then we've got something I call MOE, which stands for monthly operating expenses. Now, monthly operating expenses are really like a little fund that you put together for those unexpected expenses. So, for example, if the boiler goes, or there's a leak, or whatever it might be, so you've got a little pot there that's a contingency fund to cover those kind of things. There's no nasty surprises. Now, of course, if you just refurbish the property, there shouldn't be any nasty surprises anyway, at least for a few years. But it's good practice to put that money to one side, ideally in a separate account, so you build up a fund. If you find you're not using it, it's there towards another property, isn't it? So, common sense things to actually make use of and will help you provide some security with regards to your buy-to-let investing. Now, what I normally allow is 10%. You might find it's less, you might find in your experience it's 5%, and certainly when I started out I did do the 10%. I then reduced it because my experience showed that actually I was allowing too much and I only needed to allow around about 5%. But you choose your own figure, whatever you're happy with. So we got those, now we just need to calculate the mortgage. Now bearing in mind, as I said, the lender's fee is not used to calculate their monthly interest, it's based on the $225,000. So what interest rate are we going to use? Well, at the current moment in time, interest rates are very, very low. So what I'm going to use is what's the default rate for most lenders, and that's 5%. So we've got 5% on £225,000. And that equates to £937.50. Okay, so now what we need to do is take these deductions off to arrive at our net rental figure, which gives us a figure of £642.50. Now bear in mind, of course, we've got this contingency in here, so in fact the real figure is higher, but I just want to play down the figures a little bit here so you get into the sense of what I'm trying to show you. So what's our return? Well, what we now need to do is take this £642.50 figure, times it by 12 to get the annual rental. And then what we want to do now is divide it by the cash that we've got left in the deal. But how much cash have we got left in? Because I haven't covered that yet, have I? So, bear in mind, our purchase price was 200,000, of which 60,000 was the deposit. Our total cash in 108,400, so 48,400 was the other money we had to put in. But we've now got a mortgage of 225,000. So that means we've pulled out 100% of our deposit, that's £60,000, and another £25,000 from our refurbishment budget. So from the 48,400 less the 25,000 gives us £23,400 of actual cash left in. And this is what we call a low money left in deal. The ideal, of course, would be to get everything back out, and I've done that a number of times in my investing career, but it's not the norm. I would say probably 1 in 7, 1 in 8, 1 in 9 kind of deals, you'll be able to pull all your money back out. So always bank on leaving some money in. So we've now got our 64250 times by 12, which equals 7,710. We now want to divide that by the money left in, so the 23,400, and then times the end result by 100 to give us a return. So that will give us a 32.94% return on capital employed. ROCE, return on capital employed. Often referred to also as return on investment, your investment in the money in the project, but means the same kind of thing. So would you be happy with a 32% return on your rental property? I think most people would. It's going to be far better than anything you're going to get in a bank, and for a good, secure property. Well, I hope all those figures make sense. Go through the video a few more times if you've not followed it, and yeah, if any comments you want to make, please put them in the comment section below. Also, if there's any other topics you'd like me to cover on future videos, then again, leave something in the comments below. I hope you've enjoyed this video. If you have, please hit the subscribe button, and don't forget to also hit the like button, as that will help our YouTube algorithm. There's also a notification bell. If you want to smash that, you'll definitely get notified of other videos as and when we put them up each week. Now, appearing on your screen right now will be some more videos which will help you in your property journey. Thanks for listening.